In this video, we will discuss about creating strategic deposits for your insurance. Before I proceed, hello everybody, this is Venkatesh. This is my Twitter handle. My YouTube channel name is Empowering with Financial Awareness, where I post contents on personal finance, health insurance, and stock investing. If you are interested in these topics, please do subscribe to my channel. So, if you are interested to know more about health insurance, you can read my ebook on health insurance, which covers the various jargons, the steps for choosing best insurance cover, critical illness, and comparison of around 100 policies from 20 plus service providers. There is no product recommendations. So, you have taken a health insurance, you have done a proper due diligence and have picked up the best policy, and you have paid the first year premium. There lies the initial enthusiasm, after which there is something where you have to renew it every year, and that is the time most of us lack discipline. Maybe it's purely that we forgot or we don't have the money to renew, or whatever may be the reason. That discipline to renew it year on year is very important, because a lapse policy proves to be much more costly, maybe which we can discuss in a separate video. But here we are going to discuss about having strategic deposits to bring in discipline for annual renewal and also to reduce your financial burden. Means you have to pay it still, but this is a different way by which you can reduce a one-time outgo. So here I'm not going to discuss one options, but I'm going to discuss two options, and the same method or the same strategy can be used for not only for health insurance but for term insurance also. So let us see, the first option is that you need to have a fixed deposit. For the case discussion, let us assume that you have taken a policy for maybe 10 lakh and it's a family floater and the premium is somewhere around 25,000 rupees per year. And for this, you need to open a fixed deposit which will give you an annual interest of 25,000, which is the premium amount. So let us see how much you need to create the fixed deposit. So it works out to be 5.2 lakhs, which you have to invest in a bank. That will give you 25,000 rupees interest. This is just a reverse of simple interest formula, and I have calculated the current interest rate of around 4.8 to 4.9 for an annual deposit. So mathematically it will be like multiplying 25,000 into 100 divided by 4.8% the interest rate, which is, this formula is nothing but the reverse of simple interest. After 1 year, this will give you an interest payout of 25,000. This you will channelize to pay your annual premium. To make it more effective, you have to see to that in such a way that this maturity date of this FD closely matches with the renewal date of your insurance. So the thought process behind this is, if I earmark and keep 5.2 lakhs or whatever is the amount X in your specific case in a bank, that money will take care of hospitalization of your family to the extent of 10 lakhs or whatever is your sum insured. So that is the thought process behind this exercise. So by now you must be thinking if I am kidding you. So the question in your mind is, where do I go for 5.2 lakhs? I 100% agree that this option is not for everybody due to the affordability, but I will not completely say it's not possible. This thought I did discuss with my friend some 3 years back, and based on the interest rates that time, he had to make a fixed deposit of around 3.5 lakh to meet his annual premium, which was doable, and he did it also. But now interest rates have come down and you need a 5.2 lakhs. But let us see another second option which will well suit for most of us. Now the second option is having a recurring deposit. Let me have the same example where your annual premium is 25,000. Now you need to have a recurring deposit where the final maturity after 1 year will be 25,000. So let us see how much monthly installment is required. So in your case, the annual premium is 25,000 and it's going to be a 1 year recurring deposit with 12 installments. You just straight away divide the 25,000 with the 12 months to arrive at the monthly installments, it's around 2000 rupees. By this, you also have a small benefit, around a small interest benefit also. For that 1 year, you may earn some interest. And after 1 year, you get a maturity of 25,000, which you used to pay the premium. And as said before, to have the system effective, the maturity date of the recurring deposit should closely match with the renewal date of your health insurance. So the thought process behind this approach is, I have a monthly installment of 1200 rupees, which will take care of my family hospitalization to the extent of 10 lakhs or 15 lakhs or whatever. Case to case, it will different. Based on a sum insured, if it is 20 lakhs, you will have a slightly higher monthly installment, which is X. But basically, this is the thought process behind this approach. So there are few pitfalls. Some 2 years back when I shared this in Twitter, many had pointed out two main pitfalls. We will see them. But very interestingly, the pitfall, whatever you point out, carries an answer as well. It's straightforward and obvious. The first one is interest rate fluctuates year on year. It's not the same. Today it is 5%, tomorrow it could be 3%, and 2 years back it was 7%. I fully agree. For option 1, you need to go for higher deposits or lower deposits based on the interest rates at the time. With the decreasing interest rate, your deposit amount should increase. So remember well, the idea is not to get returns, but the idea is to have a discipline to renew insurance when it is due and make the funds available. So that is the main idea behind this whole exercise. And so based on interest rate fluctuation, you have to increase the deposit amount in case of option 1. The second pitfall is health insurance companies increase their premiums every few years. So as I told you earlier, the concern what you say also carries the answer. Yes, companies do increase. So with increasing premium, you have to increase your deposit amount in case of option 1 and your monthly installment in case of option 2. I had shared this thought process some 2 years back in an article. So, but however, it did not get much traction. Suddenly I got this thought that if I shared this over a YouTube video, many could get benefited. Friends, thanks for watching this video. I hope you liked it and understood the important aspect covered in this video. Please do share this message with your friends and relatives. And most importantly, if you like this video, do like and share this video. If you have any comments or alternative views, feel free to share it in the comments box. Thank you once again.